One of Seattle's biggest and most long-standing real estate developers, Martin Celig, he's defaulting on more downtown office property debt. What's the dealio? I think you know. Let's get into it. Here we go. Now, one of the considerations here, when I was reviewing this story, I was like, Martin Celig is still alive? Guy's got to be ancient, because I've been following this guy since high school. He was developing back then. I mean, this guy's been around forever and ever and ever. Well, you got a situation. Seattle is no different. You've got some street conditions that are tricky at best. You've got interest rates that have gone through the roof relative to where they were a few short years ago. We had that inflation, interest rates jacked. And so you've got a situation where downtown cores have all, emptied out. We had that work from home thing. Now everybody's trying to get, all their employees and state workers and everybody else, federal workers, back into the office, because without all the people in the office complexes, the downtown core isn't kicking off the money it was, not only just for the city's coffers, for the taxes aren't pouring in like they used to, but for the developers. And the developers are the ones on the front line because they can't refinance because rates are too high. They don't have the numbers to put together a new appraisal based on, what comparable sales are closing, what few buildings are closing, because nobody's selling in this market unless you're absolutely bailing. So Martin Celig, he's defaulting on more downtown office property debt. And what is that? That is usually a negotiation. He's been doing this literally since the 80s, like any smart real estate developer. And he's a billionaire developer. So this is nothing new. But what this does is this kind of shows the emphasis, the constriction of capital into the commercial real estate market, and the inability of these guys to just go out and get a refinance and go, all right, that loan's due, but we're going to switch it out with this one. Can't do it because they don't have the numbers to back it up. Because, a lot of these places are vacant. Tons of these places are vacant. So Martin Celig, the commercial property developer who at one point owned nearly a third of downtown Seattle office space, defaulted on debt backed by 3 buildings located near the iconic Space Needle. This is all downtown Seattle stuff. And a lot of this stuff, it is impacted by street conditions of what's been going on. On top of, Seattle had a lot of tech companies that said, hey, you guys can all work from home. Amazon being one of them. Amazon is back now. But Amazon is basically in the South Lake Union area, a little bit to the east, to the north and east of the actual downtown core. Not by much, but enough where it's much, much safer than downtown. Talking Pike and Pine 3rd, the Blade area I talk about all the time, because that's the poster child of where you don't want to have commercial office space at the moment. The $135 million debt has been transferred to a special servicer, according to monthly commentary. A spokesperson for the company called Martin Celig Real Estate said conversations regarding the debt are ongoing. Celig's business has been confronting the fallout from higher interest rates, which has made refinancing debt tougher, if not impossible. Office demand in the city is struggling to rebound as many companies still allow employees to work from home, even though Amazon workers are back 5 days a week. That's why there's this huge push. Hey, get your ass back in the office. We've gone from we went from that kumbaya moment of we're all going to work from home forever, we're going to fight COVID, to good Lord, we need some more money, we need some more tenants, we need some more businesses, we need some more volume going through our downtown cores because they've been hollowed out. Because now you've got developers doing this kind of stuff. Because what is this? What's going on here? This is like during the Great Recession, when homeowners, if they were wildly upside down on their mortgage, meaning say the house is worth $200,000 and they've got a mortgage on it for $300,000, if they're current on their mortgage, their lender isn't going to look at them and let them renegotiate or do a short sale. If they need to do something with that house, they got to do something. If they're current, best thing they can do is start defaulting. And that's what this is. This is a move to get the lenders to do something. Hey, we're going to refinance you. We're going to renegotiate. We're going to extend out the terms, any number of things. And that's exactly what residential lenders did during the Great Recession, just in mass numbers. But this is what you've got going on in the downtown cores right now because of the conditions we just talked about. Martin Celig Real Estate has defaulted on other Seattle office debt. Last year, the company warned about issues with roughly $380 million of debt tied to 9 properties. Spokesperson said the firm is working with a special servicer on loan modifications for that debt. Yeah. They're going through and they're looking at their portfolio and they're saying, all right, yeah, this one isn't working. What can we do here? Well, let's default. Let's get the lender to write that debt down to here. And then with the tenants we do have and the current numbers of tenants, meaning what tenants are willing to pay in the current market relative to where they were pre-COVID, those markets are wildly different. You've had a massive change up. Some property owners have opted to default as a way to kickstart negotiations with lenders. Absolutely. It's what you do. Right? It's what you do. Because if a lender looks and goes, hey, you're current. Why would I talk to you? Why are we negotiating with you? We've got all these other, dozens and dozens and dozens of properties that are in default. Why am I talking with you? Well, here we go. Stop making that payment. And your lender will hop on board. You got to be, a handful of payments though. You got to be serious. You got to be willing to go the distance, right? Hey, you want to foreclose? Come take it. They're not going to do that. They don't want to foreclose. They're not in the business of taking properties back. That's not how they make money. They make money on servicing and you paying them interest. It's unclear exactly what Celig wants to do with the latest group of buildings, which includes properties at 4th and Battery, 3rd and Battery, and 333 Elliott Avenue West. These are all, again, downtown core properties. Oof, yeah, no thanks. Celig's once vast portfolio of Seattle office buildings is almost entirely concentrated in the downtown area, where the office vacancy rate was nearly 33% the end of 2024. Worse than areas such as Tacoma's Central Business District and Redmond, which is where I'm sitting basically, which is home to Microsoft. Interesting to note that since the pandemic, foot traffic is still just 63% of the levels seen that month in 2020. So February of 2020, now we are at 63% of where we were back pre-pandemic because everything was normal. We didn't have the work from home. It's going to go forever. That little social experiment that went wildly sideways. There's no money for the city in tax revenue. All that has rocked these markets in the downtown core. I did a podcast yesterday and I was talking about Oregon and what Portland is going to be doing. Portland is trying to figure out, okay, yeah. And the interesting thing is they were analyzing, what are we going to do with all these properties in Portland? What can we do to bring people in? Businesses are no longer coming here. So they're going through, let's set up a music venue. Let's do arts and crafts. Let's do this. Let's do that to get people to come in. And the bottom line is, no matter what the use is, people aren't going to come if the street level is decimated with whacked out drug addicts shooting up, smoking it up, and doing just crazy things on the sidewalks and on the streets like they do in downtown Seattle. You got to clean that up. People are not going to lease, and that's literally what's going on. And if they are going to lease a property, it ain't going to be in Seattle. It's going to be in Bellevue. That's where everybody's going. So, that has been an ongoing thing. Amazon moving workers from Seattle to Bellevue, Seattle to Bellevue, Seattle to Bellevue. Because Bellevue, it doesn't have a homeless problem. You have no homeless in downtown Bellevue. You have no homeless. It's just not that way here. One of the Celig properties tied up in the defaulted debt is located at 2400 3rd Avenue. That is, where is that? Yeah, I've got it right here. So that is Belltown, kind of north of, it's about 6 blocks north of Pike and Pine. So here it is right there with that red. And here's Pike and Pine with 3rd Avenue. So like 6 blocks to the north. It's in the heart of things. I mean, not where you want to be. But it's downtown Seattle, and it's impacted by all this ridiculousness and the fact that, there's not a ton of leasing going on. Leasing has been consistent, but it hasn't been the huge numbers pre-pandemic that we saw, and particularly in this downtown core area. You've got Seattle, you've got Portland, you've got San Francisco that all have similar characteristics because they have allowed street level conditions to deteriorate because, build it and they will come. You build all of this infrastructure for the whacked out homeless, allow them just to be wherever, and they're not going to go away. They're not going to go away. So not only are these developers like Martin Celig battling interest rates, work from home, super high vacancy factors, but you got street level conditions. Then when people walking around, they're going, I don't think so. No, pass. I don't think so. Let's go out to the burbs. Let's go out to the burbs. Let's go across the bridge and let's go across I-90, go across 520, and let's go into Bellevue. Let's go into Redmond. Let's go into Kirkland. Let's go into anywhere but downtown Seattle. Downtown Seattle, used to be the, flagship for the whole city, the whole area. But it's become so bad that, folks who run big companies say, I don't think so. Starting with Amazon. I don't think so. They've got a space just to the north of the Blade, Pike and Pine and 3rd that we just looked at. And they have consistently said, no, we're not putting our employees back in there. They, got out of the lease and said, no, we're not putting employees in there because somebody might get, whacked by some whacked out fentanyl addicted nut job running around with a machete. That's a pretty common thing. It's not that uncommon. Maybe a sword, maybe a samurai sword. All bets are off. All bets are off. And, I joke about that kind of thing, but it happens all the time. I read about it right here on News for Reasonable People. All right. So what will happen with these properties? They'll go through this default process for a while. They'll refinance these things. They'll get them back up where they kind of cash flow. But these properties aren't going anywhere. It's only the smaller operators who are wildly undercapitalized who have to sell or basically just, get pushed out because they can't make it go. Developer like Martin Celig here, this is negotiation. That's what it is. But it's not only market conditions, it's street level conditions as well. So there's that. All right. That's it for me on this one. Thanks so much for being here. I'll catch up with you in the next one. Bye for now.